Look, let's start with the latest moves in the economy here and around the world. And for the federal government, the honeymoon is well and truly over. It now has serious challenges that it can't sheet back to the previous government, the war in Ukraine, or external factors, or even the Reserve Bank. This week coming, the latest monthly measure of inflation will be released. And along with sales numbers that are due out on Thursday, they represent some of the last data the Reserve Bank will analyse before its next rates decision in early July. But with inflation falling in America, there are signs of rates topping out in the coming months. So that opens up the opportunities for investors in bond markets as central banks' policies turn more neutral. Mind you, with cash rates rising around the world from close to zero to between 4 and 5%, bond investors have been absolutely battered over the past 2 years. For US bonds, the falling capital values as rates have increased caused the worst year on record for bond investors. Well, one who seems to have survived is Michael Leithead, the UK-based head of fixed income, EFGAM, who manages the new Capital Wealthy Nations Bond Fund. And I spoke with him a little earlier.
Looking at the economy going forward, just globally, we kind of see a period of anaemic growth at best, and at worst, I think we're looking at some recessionary periods around the world. How deep they are is still, it's still difficult to say. But from a bond perspective, when you're looking at returns into that environment, the return profile looks a lot more healthy. So last year was a bit of a shock in terms of the pace of rate rises, and that has pushed yield curves higher. But I think that is coming to an end now, and where yields are where they are today, I think you're getting good optionality out of bonds.
OK, so you're looking forward, you're casting your mind forward. And say, for example, the UK this week, it continues to raise interest rates, its cash rate up by 0.5% to 5%, as they can sort of see the looming recession, the looming sort of inflation is still there. But the offset to that is a recession. And at some point, they have to reverse that policy, don't they?
I think so. I think they have to do it, in retrospect, though. The problem is inflation is so high at the moment. The key thing for central banks everywhere is really maintaining that credibility in terms of inflation fighting. We've been in a period for the last 10 years where they've really struggled to get inflation above target. Now we're running way hotter than target. They're going to be looking at backward-looking indicators to make sure they've got their credibility back. And unfortunately, I think that means tighter policy in the near term. And what the markets are pricing in is really that they're going to have to reverse that policy in the future. So we're seeing inverted yield curves pretty much around the world.
Yep.
I think the question is how far do rates have to get cut in the event that growth slows down.
OK, so then I come to Australia, say, for example, because one of the big issues here in Australia is that you've got rising interest rates, as you do in the UK, as there are clear signs that the economy is starting to soften. But the inflation is sticky, it's not going away, so the rate rises keep on coming. And that's the thing that they talk about, this narrow path. But, of course, the precipice off the side is the prospect of a recession.
Yeah, I think so. I mean, I think the problem has been in a lot of economies that labour markets have just been so strong as well. So the really big concern is probably that if we were seeing unemployment rates rise, that there would be clear signs of an economic slowdown and price pressures being released. I think the problem when you look in the UK in particular, we've seen high levels of wage inflation. That's surprised to the upside the last couple of months as well. And so that's what central banks are looking at. The economy is still resilient. And so I think they're looking and saying, we need to hike rates further, whether we're looking at a recession or not. And we just have to see how things kind of pan out. So whether it's here, the UK, Europe, I mean, things are looking like economic data is secondary to price data right now.
OK, so then you sit there and think about the central banks of the world that effectively bought back all these bonds under quantitative easing when COVID was on to try and rescue the economies, to try and make certain there was enough liquidity in their economies to keep the economies going. So they've got all of these bonds that right now are so far underwater, they almost can't contemplate selling those bonds. That's the problem, because they crystallise so much in losses. So does that hamstring them the next time around when they've got to try and stimulate their economies in the face of recession?
I think we're probably going to head into a completely different rates environment in some respects going forward. I think different central banks have adopted different policies. I think here in Australia, you've obviously held on to the bonds. I think, the UK, we've seen I would say, a fairly aggressive bond liquidation program from the Bank of England. ECB is a little bit more, maybe a little bit more muted in terms of what they've done. And in the Fed, they've tried to reduce the balance sheet size. I think those balance sheets are still going to remain elevated. But when you look at what central banks have done in terms of raising rates, actually, I think the main pivot point at the next sort of downturn is going to be rates first. So historically, in the US at least, over the last 50 years, when we've seen a recessionary environment, the Fed's cut somewhere between 400 and 500 basis points. And you can see they've really built that into the front end of the curve, into policy rates today. So I think they'll look to run those bonds down and maybe reduce the size of the balance sheets, but I don't think there's a need for aggressive quantitative easing, and I don't think they necessarily need to realise those big losses they've made over.
Well, I was going to say that because they may get a chance at some point when really they've actually got a situation where rates are lower than what they are today to start to liquidate. But the problem is, as soon as they start to liquidate, they start to tighten monetary policy as well. So, the timing of this is really, if you like, the more delicious thing as they try. And the other option is, as the Reserve Bank has said here in Australia, we'll just hang on to these and we'll let them over 10, 20, 30 years even, just wash off the balance sheet. That's the other option, of course, but it's a very long-term strategy.
Yeah, I think when you're looking at central banks, they can think long-term. I think, it's difficult to quantify exactly how much, pressure, reduction of balance sheet size will put on bond markets. I think in the UK, we've had a less liquid market. Gilts have not been a popular investment for many overseas people, particularly after the Liz Truss debacle last year. The liquidity and the impact of quantitative tightening has been much more significant. I think elsewhere, they're certainly more prepared to let things run off. So I think, central banks can take the long game here. And if they add 10 or 15 basis points to the long end of the curve, because they're reducing balance sheet in a period where they're much more comfortable with, say, steep yield curves to stoke growth, then I think they can do that. But I think interest rate policy is going to be front and centre for the near term.
Michael Leithead, many thanks for your time. Really appreciate it.
Thank you, Ross.